One of the most valuable lessons I've learned over the past decade in real estate is how essential it is to learn from the industry professionals. That's why I'm gathering professionals from across the country to share their experiences with you. This is a Gregerson's podcast, where experience and passion come together in the world of real estate. I'm Casey Gregerson, your host, and I'm very excited you're tuning into today's episode. As always, if you have questions for me or any of our guests, please reach out to me at casey@gregersonproperties.com. Now let's get started with today's podcast. All right, introduce you guys to Rivers Fike today. Rivers and I worked together at Shell for many years. I've started around the same time. He's also a fellow engineer, but also been a real estate investor on the side. So anyway, it's going to be kind of cool to show you guys today, like what if you want to be a little bit more active in real estate in your full-time job. Rivers has done a really good job of, I think, mastering that. And also Rivers has started to tap into, hey, using your money to lend your money out and how to secure it and how to underwrite it and feel confident about what you're investing in and set yourself up for success. And really, we've kind of created some cool win-wins. So anyway, Rivers, what kind of tell us your background and how you kind of went from initially from your full-time W-2 job at Shell and then moved into starting to buy real estate?
Thanks, Casey. Yeah, I started buying real estate, bought my first property back 2013, single family house in the town I grew up in. And since it slowly grown that portfolio, brought on a business partner, Sam, up in Philadelphia, and we shifted mainly from investing in Mississippi up into the Lehigh Valley, where that's the majority of the units we own are up in the Lehigh Valley, Pennsylvania. So Bethlehem, Allentown, Easton area, some in Reading. And then more recently have started expanding over to the Texas markets and getting into some private lending as well.
Awesome. Nice, man. Cool. So you guys, where are you at today? Kind of what's your kind of between like properties, units, like kind of roughly what do you own right now?
Between 90 and 100 units right now between our different entities. Some we own together, some we have individually, but we've kind of grown it up to that. And we want to keep it around there, around the 100 unit mark is about where we want to keep it for now. Most of those are under property management in the Lehigh Valley. So biggest building, I think we're up to 9-unit building. And yeah, most of them are privately managed. Some are managed with a property management company. Few we manage ourselves. But yeah, we've just been slowly growing it up over time. Most of the acquisitions sped up a couple years ago, 2-3 years ago in acquisitions, right before through the start of COVID buying. And we're just a mix of financing from commercial to conventional loans at a variety of different banks. And yeah, they've been able to build it up that way.
Got it. And what initially, Rivers, give you like the confidence to go out and start to buy real estate? And like kind of where did you learn maybe strategy?
I would say there wasn't as much information out in 2013. I actually looked at bigger pockets, just do some basic underwriting, and then didn't really know much about it. My grandmother is a realtor or broker. She still is in her 80s. And so she kind of helped me with the first transaction. Ended up actually did the first transaction very low cost, went in, basically lowballed, offered on a house down the street from where I grew up. The market was pretty slow at the time, was able to get a good price on it, and basically just had an attorney draft the deed and paid cash for that one. And then was pretty risk averse to leverage at the time. Didn't really understand good debt, bad debt. So started learning about that over the years. Looking at, I think a book pretty influential to that for me was Cash Flow Quadrant, Kiyosaki's kind of follow-up to Rich Dad, Poor Dad, looking at understanding different debt structures. So kind of going from a Dave Ramsey model where it's kind of like risk averse to debt, to understanding that, to save up $100,000 at a time to buy a property, very slow to grow a portfolio. Realize it's going to take some leverage, responsible leverage to do that. And then ended up getting a line of credit on that first property, essentially doing a cash out refi on it, but it's just as a line of credit. And then was able to, over the next few years, just making a lot of offers on houses, single families, and making like 20 offers, maybe buying one or two, using the money from the line of credit combined with financing to purchase a few more, and kind of followed long-term construction of basically building a tire plant within 20 miles of where I grew up. So I knew about this. Continental Tire was putting in several $1 billion facility. So I thought, okay, there should be a path of progress with that development for housing prices in that area, good school district. So I just bought a few houses in that area, and those have all done well. So nothing crazy, but buying $100,000 houses back then. Now the houses are, the cheapest house now in the area is like one in the 170s. So just some base hits, starting off nothing, no one deal. To me, it's like an accumulation of small wins in the real estate game, like $50,000, $100,000 opportunities, buying at the right price, holding has been the model. Yes, growing it from there. Exited a few properties, exited a few that have come up. Just basically marketed one, had an off-market offer on the other, and held on to everything else.
So yeah, I love it how you kind of grew it small, and like the fact that even if other people can conceptualize, like they were buying properties, spent $100,000, paid cash, and I love it how you evolved from like paying cash, being very conservative and safe, but then literally once you bought that first one, you took a line of credit on it and allowed you to buy the next one, but you got the confidence because you didn't take a bunch of risk with any leverage on the first one. Got the confidence and just kept repeating. And the base hits, I like that. It's good
yeah.
Good concept.
And I look a lot at, I think about basically debt essentially across the portfolio. Big questions around what is too much leverage. So basically, I try to look at our whole portfolio and think about kind of an overall leverage perspective. Then I think about different amortization lengths on different loans. So I have anywhere from 15-year, which a lot of investors are not getting any 15-year loans, but I actually had a lot of discussions on this. I have a range from 15-year, 30-year, interest only, a mixture. And I think that average amortization length is good to have some that are paying down faster. Not the most efficient from a return on equity, but it helps the asset base. So to me, I like a mixture where some properties are building up equity faster. Certain properties are more set up with their debt structure for cash flow. And so I think about that purchasing a property to try to look at the overall debt structure, think about the time that debt's coming due, and think about the time the amortization schedule on those different loans. So that's what I'm thinking about a lot nowadays.
Yeah, that makes sense. Well, let's segue into now when you kind of made the progression into like private money lending. And just for the background, me and Rivers have worked together for about 5 years he's been a private money lender on some of our projects, and it's worked out really well. But I'm just curious, Rivers, like how did that transition look for you and at what point you became comfortable of, hey, and I assume it's a natural progression. Talking to a lot of other people, it's like, hey, you work hard, you build assets in real estate yourself, but eventually everybody wants to be the bank, right? Because then you're not doing any of the work. But I'm just curious how that evolved for you when you made that kind of step.
Yeah, like you said, we started out working together. I think I remember when we started the discussions back about 5 years ago, I think the need was challenges around traditional hard money lending. I remember your challenges with that essentially around a couple things with the draw schedules. Typical hard money is going to have, let's say you need 5 or 6 draws. They're going to charge you 3 points. They're going to charge you 13%, 14%. They're going to then want you to front, if it's a $100,000 project, they're going to want you to front $20,000 at a time as you do your construction draw. Then you pay another $400, $500, $600 for a draw. So you end up paying maybe 20% on this money for a $100,000 loan for a year. A smaller loan amount, more expensive it gets with the construction draws. So we thought about that and realized there was some spread between essentially one of the things that just in conjunction with me looking at real estate is understanding securing lines of credit, securing access to capital. So that's something I spend a lot of my time thinking about and looking at. So basically to pair that kind of skill or subset I developed with people that are more actively investing, because there's only so many working full time. There's only so many deals I can take down. Basically, I have to buy something that's completely ready to go, rent ready, maybe just very small, couple thousand in, updating that a contractor can do in a day or so. But everything I buy has to be basically move-in ready, turnkey. And there's only so many deals out there that I can take down, that I have the bandwidth for. So this is just allowed me to pair essentially an access to capital that I have been working on, and something that we've gotten pretty good at as a partnership, to people that are more actively pursuing deals where they can make a bigger margin and they have the time. I can make some margin and basically create a win for both parties.
Love it. Yeah. So to summarize that, Rivers, it's like Rivers has got limited amount of time because he's still active in real estate, but he can only take down so many deals. We've got other active investors who don't have the right terms because they're going through a hard money lender who's got, as you mentioned, we're charging points, there's draws, there's all these like hoops they got to jump through versus you bring them together. Now you're able to put money at a good competitive rate, interest rate. And then the investor on our side, the active side is able to borrow and actually execute. But I think the missing piece is like how you get comfortable, right? So Rivers, tell us like how you started to underwrite these deals and how you felt confident and secure in the way you were investing.
Okay, so for underwriting, I used a lot of the real estate knowledge that I'd gained in just doing some of the deals on my own. We look at a slightly different setup than normal hard money. And basically, we look for people that have an existing portfolio or have some stabilized assets. This is basically what allowed the more collateral than a normal hard money where there's not construction risk or draws, but basically allowing people to leverage and underwriting existing stabilized assets. Let's say you've got a portfolio of 5 rental properties that have, 60% loan to value on them. You've got some loans, you've done some work, you've maybe done a cash out refi, you've got some equity there, but it's hard to access that equity. So we basically say, hey, we can be backed by a real asset and underwrite it that way. So have essentially a real asset without the construction risk and allow people to leverage the equity that's in their portfolio. So it narrows down the pool of borrowers a lot, but somebody like yourself, it's hard to lend to somebody on their very first. That's not really something I'm able or have the bandwidth to do that, hey, can't manage that. But somebody that's got a built up portfolio, a small portfolio that we're looking at continuing to add on. Most people I talk to are looking at buying, do the BRRRR method, rehab, and then a long-term hold a lot of times on the portfolio.
Yeah, perfect. And to touch on one of the things you said, Rivers, as far as like the equity that you tap into. So perfect example, this house that we've actually partnered on is a house that, and I think a lot of people can associate this because this is what's happened to a lot of other people, is I borrowed on this house at 2.75%, right? And my loan amount is like $400,000, right? But the asset is worth now $700,000. It's appreciated a lot. But yeah, I could go to a bank and I could refinance that and get some of it out. But A, I'd only probably get up to 75, 80 max. And then B, then I lose that 2.75%. So the cool win-win of this is I can now leverage, there's a lot of equity there to where Rivers or the private money lender can feel secured. It's a good stabilized asset. It allows me to not have to go sell that asset or go refinance and get rid of that rate, but at the same time, access capital to it.
I think a lot of people, what I've had to get my mind wrapped around, and a lot of people may be concerned, like I run into this question or whatever, it's like, hey, don't want to have a high interest rate private loan or hard money loans. These are higher interest, and they're going to be higher interest than your conventional bank loan. But that comes with a couple of things. It comes with flexibility. So there's a lot cheaper to close. Like on that example, we're able to use existing appraisals a lot of times. Like, hey, you just did a refi. We got the appraisal. It's good enough. The numbers are close enough. A little more flexibility with a private or a hard money lender than your first position or your conventional lenders. The other thing is you have to look at your portfolio. Like if you said, well, hey, I could refinance to 8% right now and you get a little more out or you get the same amount out, kind of overall debt percentage or your overall interest rate, your private loan should be the smaller percentage. It's a supplement. It's either a supplement to get a bigger conventional or commercial loan to maybe go for part of that down payment, or it's a short-term bridge to get your house or your property rehabbed, and then you're going to cash out of it, and you can then redeploy that private money. So it seems high, but if you look at it overall as an average, it brings it back into probably lower than current interest rates if you do the math on that.
Yeah, absolutely. So add a couple different things. First off, you're talking, it's basically like a weighted average. If you look at your weighted average, your rate is still lower, right? But here's the other thing Rivers didn't mention is like on our side as the active investor, we've got the flexibility to, depending on your terms, but typically I can pay it back sooner too, right? So I got the flexibility to where if I've got a short-term need, or again, if we're doing the BRRRR strategy, whatever it might be, like I can use that higher interest period. And as Rivers mentioned, it's going to be higher interest based on it's a little bit more risk because it's in second position. But actually, I'm going to go into that really quick for a second, is because traditionally think about two different ways that you can invest as a private money lender. We could do the conventional way, if you want to call it that, is where you're first position and there's only one, you're like the only lender on the property, right? So that's more conventional what people are doing. But as Rivers said, there's risk in that, especially if it's construction or fix and flip. you as the private money lender are depending upon that operator or that owner or that investor to deliver and stay on budget. And I mean, to me, from what I've experienced in real estate, the biggest risk is on the construction side and when you're rehabbing and doing all that, right? So there's some risk, but you're in first position. So on the flip side, what Rivers is talking about is being in second position on an existing cash flowing asset. So arguably the risk is low. Even though you're in second position, the risk is arguably lower.
It's just a different position or different space. So the second positions are not as common, especially in the last 15 years, not as common, but you don't have the construction risk. You do have to be capitalized. So you anytime we take on a second position, we're looking at that first position, looking at downside risk. You essentially would have to, in a foreclosure scenario, low probability, but you have enough loans, it can happen. Basically have to be ready to take over, buy out that first position loan. So you got to can be fairly capitalized, but these rates are pretty low. Foreclosure rates on private loans are very low.
Well, that's good. I love where you're going with that. I mean, because the other thing I was going to dive into is just kind of playing that out, right? So people, if it's somebody who's really thinking critically about the risk in being a second position, like what are the hypotheticals? So let's play this out. If something happens to the investor in our situation, if I stop making my payments or something happens to me, right? There's a first mortgage position. And then like if Rivers is the private money investor, he's in second. So let's kind of play that out. You kind of talked about, I think the worst case scenario is Rivers has got to come up with the capital to buy out the first loan. And now he owns the property.
Yeah. In a foreclosure, it can be auctioned essentially depending on the state, the area, but so seek your own details in your area. But in general, essentially foreclosure, if you have a forced sale of the property, it can be auctioned, and the proceeds from that auction, the initial proceeds will go to the first position to pay off plus the legal fees with the first position. After that, it goes to the second position. So it's the second position. If it bids for, if a property were to sell for under that threshold the combined second and first position price, then you should remain whole in that sale. If, let's say it's $200,000 property, you've got a $100,000 prime first position, $50,000 second position, and that property was at auction for $125,000. You can, as the second position, you have the right to essentially buy the property at $126,000, pay off the first position, and now you have the property, can go market it or finish construction or buy and hold. So there's essentially the estimates that I'm talking about. Essentially, we're expecting less than one or less % default rates. From what I've gathered in the private lending markets is where the averages come to. Of course, that can vary, but essentially you have some protection in the downside case. And so that's one thing I look for in underwriting. And I think people are concerned about a couple of things. One is it's more of an individual relationship with the person. You basically have to have trust in the borrower. With Casey, I'll look back over the years, you've grown your business. We've been through the good times, the bad times, but the thing with you that I've seen is resiliency. Basically, you want to see somebody that even when the fire happens or the construction drags out, when the money is tight or there's some issue that arises, because there will be an issue with any business, that the person remains true to their obligations. And so this is something that I've seen with you that really helped build that rapport and that trust. And, every lender has to do their own due diligence with that. But understanding the person, I think that's where a lot of people get nervous about either not knowing about the worst case scenario, not knowing the person. And then there's some benefit, I think, into spreading out the capital amongst different properties and amongst different borrowers. And that's something that I think can help people alleviate some concerns about private lending where, hey, if you have a pool of, $100,000 to deploy, it may be less risky to deploy that across 4 different borrowers. Maybe it's not needed depending on the individual case, but I think that's something that, hey, maybe splitting it across different properties or against different borrowers can be helpful to people that are especially getting into private lending. It's hard to do when your first one has to be with one borrower. So it's kind of that initial hurdle is hard unless you can partner with a person that's already lending that can help you spread that capital out. And that's something that this point that we're looking to start helping people do is where, hey, we have access to different borrowers. different lenders and trying to put those people together where somebody that hey, I've got 50,000 I want to invest. Well, I don't want to put all my eggs in one basket though. Well, that's somebody that I would like to have a conversation with and say, hey, maybe we can de-risk this just by saying we can split this across 3 or 4 different investors where you have the same or slightly lower return, but you're able to have a more predictable outcome where you're not having the downside. Your downside risk is a lot more mitigated by kind of pooling with other investors.
Yeah. Ooh, let's dive into that one a little bit more in a second, Rivers. I really like that concept, but it kind of I really like how, and hopefully people listen to this can kind of see how Rivers has approached it and how he's kind of de-risked it and looked at all these different kind of worst case scenarios and how you mitigate them. Another thing I want to highlight that you said is about the relationship part, right? You know who you're investing with. That's a big part. And I think the other way that comes into play is in that worst case scenario where they default or they can't make the payments more times than not in those bad situations. What do you think is like kind of people like maybe just thinking about getting into private money and like lending out, but they're not sure and maybe they don't quite have your experience level in real estate or knowledge, but what would you say to those people to dip their toe?
I think the biggest holdups for people is for a couple different reasons. One is a lack of knowledge on real estate. Is to say, hey, a comfort level where you may not have bought a lot of properties or done a lot of deals, so not be able to see the numbers. Like, hey, it might not have that intuition of this deal is going to work or this deal is definitely not going to work. So the basic underwriting of is this person going in, they got the track record, but is this individual deal correct? And that's what I think where lending on an existing asset takes out that need for the ability to estimate construction costs, construction timing. So you take those variables out and can just look at essentially the statics of rent and rental income and fixed costs. So that's, I think, a holdup that a lot of people have. I think the second is saying, hey, I see a lot of people that just have, and this is where I feel like I can probably help people the most, is that essentially a lot of people have a fear of they have their money sitting in a checking account and move that to a high yield savings account. And they're nervous about the stock market or they're nervous about other investments. And they kind of stop there. A lot of people sit with it and get to the point of a high yield savings account, maybe a CD, and that's about as sophisticated or as complicated as they want to get. Anything else is seen as risky. Like, hey, stock market can draw down 40% a year. Historically, in the worst case years, this has happened. People are nervous about that. They've saved their 100,000. They saved their 50,000. They saved 25,000. They don't want to see it come to turn into half of that. So I see this as a risk. So anything outside of that, and then when they're saying, hey, we got a private lending, it's a good return. It may be triple the return of your high yield savings account. People expect a lot of variability in that. But in reality, it's actually pretty stable. It's more like essentially it's a bond or a mortgage. You're buying or owning a similar interest or instrument as a bank. And it's just a flat return. So there's some different risks. You got to make your own decisions about the acceptance of that risk and how to manage that can be for different people. But that's essentially, to me, the big hold is people taking that jump from, took a lot of just like, they either like to see it in the account, don't want it to ever go down. It's psychological. People have it's a known psychological factor that people have. They would rather, it hurts worse to lose $100 than to make $100. It's a psychological of a risk aversion of loss aversion. It's of how it feels. So people would say, nobody's really saying to themselves, hey, I'm at a 3% or 4% in a high yield savings account. Well, I just eroded. My money's basically eroding with inflation. They just see the static number not moving or slightly going up every month. But I would say take a look. Private lending, you can see, okay, deploy capital. A year from now, you have more in your bank account, and it's not something like the stock market that's going to go fluctuate as much. It's less variability. Some like tail end risks are out there. But once you understand those, I think it can be a good vehicle for a lot of people, even people starting in investing. Can be a good vehicle for that.
Yeah, I love it. One thing you reminded me of, Rivers, when you're talking about that is that, again, talking about our difference between a first position lean on like a fix and flip versus like a second position longer fixed, right? But the other difference is that money stays deployed, right? So I always tell our investors this, and I want to get your perspective. If you put your money into fix and flip, I actually like that because I'm only going to pay you for the time that I'm using the capital, right? So I might give you your money back in 90 days, and then you got to figure out, and you got to do all that paperwork, right? And then to go to the next deal, we got to do another set of paperwork. And there might be a gap in there, right? Hey, let's secure it, make it more like a line of working capital. And then Rivers is going to get, say it's 8, 10, 12%. He's going to get that full amount over a year and not have any gaps, right?
Yeah. So to me, I see it as a win-win for basically, for both sides of the transaction. It's one for both people. It's less paperwork, less hassle. We basically file one set of paperwork and it's ready to go. We don't have to revisit every 3 years. I don't have to keep up with whether the electrical systems went in right or the HVAC install. So it's easier from the lender perspective. From the borrower perspective, if you have enough deal flow, it makes sense. If you're only doing one flip a year or one flip every other year, it doesn't really make sense. If you have enough projects to keep the capital moving, it makes sense. Where one of the big ways that the typical hard money lender is making money is off the 3 points at closing. So if you have 4 properties you're doing a year at 3 months each, and you're hitting 3 points each time, well, that's 12% of the loan value that just got ate up in fees. Where keeping it deployed, you could save a ton just by not having to churn the money. So it depends on your specific portfolio mix, like what your projects look like. Are they really short term? Do you have a big gap between the projects? But if you have enough to keep you active, then that smaller amount of high interest capital can be deployed, I think, effectively.
Yeah, it's been a really good way. I agree. Works on both sides. Go ahead.
And I see it as a win, essentially. Like, this is the borrower and the lender are benefiting, but it's also the people living in the property. Essentially, you're taking a benefit to the communities that are able to get capital deployed efficiently is how the American real estate market works, right? So you're taking houses that are lower standard, you're investing capital with the hope of return, and then you're improving the properties where either there's a higher value for a family to then buy it and occupy it, live in it, or to rent it. But you're basically taking properties, no matter what, you're taking a property because of this efficiency in the capital transaction. You're able to then take that money and then make a better place to live for somebody, whether that's a new owner, a new resident, renter. They have a better place to live because of this. So to me, it's a win for the 3 different parties involved.
That's a great point. Yeah. From borrower to investor or lender to the actual homeowners. That's full circle.
Yeah, because that's the thing is like this. Our whole country's economy is basically built off of this. It's not the government is not deploying funds to build everybody's house. It's private investors like yourself saying, "Hey, let me get this capital together, and you deserve to make money off that transaction." But the people receiving into that, getting a good product. So I think it really helps boost those communities that you're investing in. I've seen it across. Seen it in Mississippi where I've invested, and I'm sure you're seeing it up in Wyoming.
Yeah, cool. One more thing before we get into kind of pooling money, which I'm really excited to talk about, is Rivers, talk about like how long you think it would take somebody to, or maybe, so really quick, the paperwork, and you can explain this more, Rivers, but it's simply a promissory note and a mortgage or a deed that gets filed, like 2 different documents, right? Happens on each transaction. And then there's also the due diligence. So, I mean, give people a feel for like how much time they would need to invest to feel comfortable going into a deal and give it some proper underwriting.
I think your first deal may take a couple months realistically to get your head wrapped around it. At this point, for me, we're looking at time frame, under a month can get from start to finish. And essentially it depends on, the more I've learned about it, it gets more and more sophisticated. You can paper it basically as much as you want. You see hundreds of pages at a bank closing or for a traditional bank loan. There's somewhere a lot less paper than that, but it doesn't take that much. A lot of these standard forms, and your local title companies, many of them can have experience working with private lenders. So that would be my advice, is you can work with your title company or title attorney in the area to make sure that, and that's what you essentially should do if you're going to originate the loan yourself, is to work with your attorneys or the title company to make sure you have the proper documents filed to secure your position in the property. That's all standard real estate practice, and that is what the bank's doing the same thing. When you go to a conventional loan for closing, that title company is making sure that the right documents are filed. That attorney is making sure that bank's interest is secured in the transaction. And they essentially do the same thing when you're private lending. And that's what their attorney's responsibilities are.
Yes. I'm glad you brought up the title company, Rivers, because that's really what people can really count on, is like kind of their neutral third party that's going to make sure you do everything correctly, right? And to clarify what Rivers said, he said kind of like, we're talking about the span of like work. I mean, he's working a full-time job and doing other things, right? So you're kind of going back and forth on terms and putting things together over a couple of months, right?
Yeah. I would say a few hours over the course of a couple of months. It's not like 8 hours a day or anything. It is just, a few emails here and there. And it just takes a little time to get, full understanding of it and work through the title companies. But that is something I think a good piece of security people have is to, you have as the lender, the title attorney is making sure that the property has correct title, and you can also employ them to make sure that you have a proper mortgage or lien placed on the property. So these companies are actually representing, or these title attorneys are representing the lender in the transaction.
Got it. I love it. So I'm going to lay this out and I'm going to frame this up for kind of talking about pooling funds, but kind of like multiple buckets, right, of people. So if you're in the bucket of like, you don't have a whole lot of time or like really any time, but you want to get into real estate, go find a trusted operator that you know and you have a relationship with and make sure you're secured. And you could do that in a matter of like hours, and they could get the right documents, and that could be done with very little due diligence, right? I'd say phase, or maybe a little bit more sophisticated, is more like Rivers, to where you actually do want to take the time to understand the property that you're secured by, understand maybe a little bit of their background and just do a little more due diligence there. But it's more so asset based, right? Knowing the mortgage amounts, the appraised value of the property. Again, a lot of those documents are already there. The rents, the leases, expenses, all that. You can dive into that, right? So that's a little bit more advanced and feel even more secure. And then also I'd say the third thing is you got a title company that's there to protect you, or not protect you, but they're there they do this all the time. Honestly, they're like a free attorney. A lot of times, depending on your state, they might be an attorney, but typically the title companies will guide you without any cost, right?
Yeah, well, the borrower is paying the cost. That's the best part for the lender is the borrower is the one paying the closing costs, and the lender is getting that service via that transaction cost included in that cost.
Exactly. So think about it. You could be very inactive and just trust somebody that you have a good relationship with, secure it right, you'll be good. Minimal time, right? You can also really do a lot of due diligence and feel good and give it some level of sophistication like Rivers is doing, which, yeah, let's segue into like kind of pooling money like you talked about earlier, Rivers, where you can spread money across different assets. Also, you can count on somebody that maybe knows it a little bit more, knows it better like Rivers, and actually can underwrite it and kind of leverage that.
Yeah, and this is something where if you're just getting started in the real estate space, private lending space, it's helpful to work with someone, seek out a private money lender or a hard money lender that would let you partner with them to deploy the capital. Maybe they take a small percentage of that, but help you walk through that process of saying, hey, let's take a look at it. Here's the experienced eye, and have the benefit of saying, hey, we can, pool the money, spread it over more properties, spread it across more lenders where you're minimizing, just like buying a mutual fund, you're spreading your risk across the, many different individual companies' performances. If you can find somebody to work with to pool several investors' money, you can then spread that across many different properties, several different borrowers, and minimize your risk of default.
Love it. Yeah, I think it makes a ton of sense. And again, you might give up a little bit, but it's mainly, again, this is geared toward people who don't want to take all the time, don't want to learn it all, or honestly don't want to take less risk. And it's always about risk reward when it comes to investing, right? This is a little bit limiting your downside, and you're probably not going to shrink your profit margin a ton.
Yeah. You're still, compared to the average, you're still beating the historic stock market returns. You still can beat the historic. I mean, you're definitely going to beat the high yield savings accounts, the CDs. It's like people seem to have a fear of like, hey, I'm making 3% of my money. I'm making 4%. Cool. I don't want to deploy it. Maybe this is a good opportunity, but maybe there's something even better. And people just a lot of times don't want to take action. It's like either analysis paralysis that we see with people just studying real estate and never buying a deal. People do the same thing with their capital. They just have it sitting in the bank, or they have it sitting, with a bunch of equity in the house. They have a lot of capital that's not getting deployed efficiently. So sometimes just talking with somebody who's done it before and say, hey, this is how it works. There's risk, but here's the deals I've done. This is how it's worked. We got a little track record here. This one falls right in line with these other 10. And it can help somebody out and kind of take that step from thinking about it to actually taking action and doing it.
Rivers, I get this question a lot, so I want you to answer it from your perspective as a private money lender. So they're saying, hey, and you've been talking about it, but hey, why would I want to go invest as a private money lender and take all this kind of maybe perceived risk when I can go put my money in a T-bill or some high yield savings and make 5%? Like why would I want to do that? Like, how would you answer that to those people?
It's a question of risk versus return. If you want a guaranteed 100% guarantee or 99.99% guarantee that you're going to get the government bond paid or the high yield savings account, and you understand that, hey, you may, over the next 20 years, you may break even compared to inflation. If we see recent inflation, it's a ton. Even historical inflation, you're seeing 2-3% will erode the value of the money in a savings account. So if you want a guaranteed no risk, but if you want to take a small risk, even taking a couple percent chance of failure can maybe triple your return. So if you're saying, hey, well, I have a little bit of risk tolerance and I would like to make a higher return to beat inflation, long-term start compounding my money, then I think it's a better fit for those people. Some people, it's just not going to be a good fit for. And then I think the ways we've talked about where working with an experienced person or pulling those funds together with other investors can help minimize that risk, taking it from even lower by spreading it out. Where if you pooled your money across 100 different loans versus one loan, then the volatility is going to lower, just like in a mutual fund. It's the same thing the banks are doing. No bank's lending to one person. They're spreading it out across tons of people. They're getting an average.
Got it. Couple minutes left here, Rivers, but I don't think I've fully dove into this with you yet on stuff, but curious your perspective, looking at like notes and kind of basically originating notes or buying notes. So where we see this happen very common in like what we do in our marketing is we find a lot of buyers who they got to sell their house and they'll sell it on creative terms, but they might need $50,000 down. Like maybe it's a house that's like worth 200 to 250,000 that will cash flow. And they've got a great rate on it. Maybe they've got a 2.5% rate, but they need 50,000 to get out of it. So in my scenario, a lot of times it's hard for me to make that pencil based on the deals I'm looking at where like, hey, I can't give you 50,000 down. But if we flip this around and we really basically process and or really paperwork, right? To where, okay, now let's go find a note buyer to sell this property to. Because typically the rate's going to be low. It's going to be a really like the LTVs sometimes on these deals are like 60, 65%. What are your kind of thoughts on like buying notes and also getting other people in? Because a big common thing we've been talking about is people who maybe don't understand the space, but getting them understand of the low risk of basically buying a note.
Yeah, to me, this market in general is very inefficient. It's not something that you can go on Amazon or go to realtor.com and buy this kind of product. It's essentially an inefficient product, inefficient market that's still transacting like, to me, it's like real estate was in the 80s. It's basically off of people's desk, or there's certain people that are in this world. They're getting phone calls. They're seeing the deals, but there's some marketplaces out there for private notes, but there's not a big marketplace. So to me, looking at buying a note, I want to understand back to the origination and understand the underlying asset. But I think, hey, a random phone call, you want this note? That's harder for me to understand without understanding like, hey, let's see the servicing, let's see the payment history, let's see what's going on. Why are you selling it is the big question. But when you're close to the origination, to me, that makes it easier. Especially if you're involved, like say, hey, this is the property, this is the deal, this is the scenario. That makes it a lot easier for me to understand.
Absolutely.
But it is definitely I think it's a viable product, and can be some cost savings in self-originating and trading this paper, essentially.
Yeah, exactly right. Well, I'm excited to share more of that stuff with our audience and with you as well. Because we're finding there's this gap between people who need to sell their house and they have great interest rates and they want to keep them in place, or maybe they own it free and clear. And then there's all these other buyers. And back to your point of like helping people like right now that can't afford a house, or maybe want to have a nice house, but they can't afford anything at 7-8% interest rates. You're basically, what we're doing is we're pairing that person who needs to sell, has a great rate. We're pairing that with this person who's got a down payment ready to be a normal home buyer. This was the same home buyer that was bought all these houses a couple years ago when it was 2.5, 3.5%, right? But now we're helping those people buy a property. But you got to have the middle person in the middle, which is a note buyer that makes this transaction happen. So it's pretty cool.
This is something that I'm seeing is basically the world of assumptions of loans, wrap loans. This world is basically was not needed when people were getting a 2%, 3% primary loan on their primary house. Now that the world has gotten to that looking like a 7-8% loan, now this world has come back to life. It's something that, same thing when interest rates historically were up in the 13%. A lot of books are written about loan assumptions. The same thing now is starting to happen, which is what I predicted would happen, as there's no need to assume a loan when interest rates are falling. People just don't do it, which had happened for so long. Now it's something that's becoming more common. And then if there's a need for a second position to make that transaction happen, that's a place where private lender could come into play.
Good stuff, Rivers. Anything else you want to share?
That's it, man. Appreciate the call.
Absolutely, man. Yeah, it's been fun. Well, I appreciate you coming on, Rivers. You shared a lot of good insights, and I hope people listen to this and they might have to listen to it again to catch it all, but listen to it from somebody who kind of understood real estate, understands how to underwrite it. Like if you're underwriting it like Rivers, you're going to be in a really safe spot. But even if you don't, even if you can kind of get up to that speed, I think there's a lot of other ways private money lenders could be successful.
And I think just reach out to local investors that do it every day. A lot of this is just knowledge. And I found it helpful just talking to more experienced investors. It really can put your mind at ease, and you learn. Okay, you get a little confidence, and hey, it's doable. It's not rocket science. It's just sometimes the information is limited, but once you understand it, it becomes second nature.
Love it. So people want to reach out to you, Rivers. Where can they reach out to you at?
Email is the best. riversf@gmail.com.
Awesome. Well, we'll share that in the show notes if you guys do want to reach out. Rivers, he's got a good wealth of knowledge. And I didn't even highlight this, but man, I love how you found different ways to partner with people and just different ways to basically leverage relationships to hit your goals in real estate.
Yep. It's a relationship business. So
cool. All right. Well, thanks, Rivers. As you may have learned by tuning into this episode of Gregor Sense, the easiest way to make real estate investing hard is by going at it alone. So as you continue learning and seeking knowledge of the industry, I want to encourage you to build relationships with other professionals who are passionate about real estate. Whether that's an agent, a business owner, or a managing investor like myself, there are pros that want to see you succeed and are willing to help you by sharing their experience. You can always reach me by visiting CaseyGregerson.com and scheduling a call. I look forward to connecting with you and continuing to share my experience with you here on Gregor Sense Mobile. Until next time, I'm Casey Gregerson. Thanks for tuning in.